Hey, everybody. It is Friday, not a Thursday, but it hasn't changed. You still know what that means. That is right. It is another episode of the Real Deal Pod with Allister and Geoff, the real estate and mortgage podcast that continues to revolutionize, inform, and educate everybody about the real estate and mortgage industry. It is episode number 80. I am, as always, your trusted realtor, Allister Carrington, alongside our mortgage guru, our trusted mortgage broker, Geoff Lee. Geoff, we're 20 days out from Christmas. How you doing, buddy?
I'm doing well. I'm ready to pull up my advent calendar here pretty soon. Is that the 12 days before Christmas? Actually, no, you
No,
pull
man.
those things out now.
On the first, buddy, you're 4 chocolates out. 5. You got some chocolates still to eat, buddy.
Or if it's a beer advent calendar, and it is a Friday today, so I could catch up. I could catch up.
Right? If you're drinking beer though, playing catch up is never a good game to play, buddy.
No.
It never ends well for you.
I know.
So break out the chocolates, catch up on those. That's okay. You do enough running and stuff like that. You'll run that thing off right away.
I know.
So any plans this weekend or what?
You know what? It's the beginning of Christmas party season. We're gonna have a Christmas party tomorrow, which I'm excited for. Me and Christina are gonna probably head out into the mainland here and go visit a Christmas store and see if I can make my little house a little more festive. She would tell
Very
me that it
nice.
looks very festive already, but you know what? Let's overdo it a little bit.
You can't overdo it, man. I am a true believer that Christmas is meant to be tacky. All right, listen, I am not, you know why? You just look at the colors, red and green, just they're not typical colors that you put together and you want to have displayed everywhere all year long. That's why I've always said Christmas is meant to be tacky. Christmas is meant to be the year you go all out, just go crazy. You have those terrible Christmas ornaments that we all made in kindergarten where like the legs are broken off of whatever you made, or that Christmas tree that you thought was supposed to be a Christmas tree is just like a hunk of clay with chipped green paint, right? That is what Christmas is supposed to be. Tacky, Geoff.
I like the classy tacky. So I'm gonna say I like the classy farmhouse Christmas look. That's what I'm going for.
Oh Lord, you're like one of those magazine people, aren't you, Geoff? Like your house has to look like a magazine.
I'll send you a pitch.
That's like
Pic,
Michelle.
pic.
Michelle's got our house looking like a magazine. I want tackiness. She lets the tree be a little bit crazy, but yeah, it's almost like Monica from Friends. You know what I mean? It's got to be like orderly and nice and not too crazy. I like crazy.
Yeah. Well, get crazy.
I can't. I'll get thrown out of my house, Geoff. I can't be homeless on Christmas.
That's true.
It's cold out there and wet. I got my mom in. My mom's has been in she got in on Tuesday. So spending some time with my mom here. She's been enjoying. She brought us baking. So that was awesome. And then we're having a little dinner for her tonight. Yeah, with Michelle's side of the family, they're coming over. So we're having a little bit of a Christmas dinner tonight. And then I bring her to the Abbotsford airport at 3:30 Sunday morning, Geoff. I am headed to Abbotsford Airport. I don't even think I didn't even think the airport was open at that time. It's Abbotsford. Who's flying out at 3:30 in the morning? It's crazy. That's early, man. That's early, but yeah, man, but it's nice. The Christmas stuff is in gear. Oh yeah, and we have our office Christmas party, I think, this week coming up too. So man, it's that time of year, man. It's that time of year where the parties are starting. So everybody, if you're partying, I'll say it again at the end of the podcast, but be safe out there. It's Christmas time. Be safe with all these Christmas festivities going on. But all right, man. Well, we got a packed show, so let's kick it. And as always, let's get started with the hottest segment in podcast, and that is
Did You Know?
Right, baby. Did you know? So, Geoff, I know that we've talked about it quite a bit on prior pods, all the things that our new government is doing to make things affordable and to start making housing affordable. So, Geoff, did you know that the federal government spending on housing is set to drop by more than half over the next 3 years? And that is
Government spending on housing. Okay.
on housing is set to drop by more than half over the next 3 years.
Do explain.
I will. So, even though we have $7.3 billion put aside for the new agency that's been created called Build Canada Homes, it is set to fall by about 56%. So currently, right now, the housing program funding is about $9.8 million, which by 2028, 2029 is expected to fall to $4.3 billion. And that's really because of the current programs that are in place. They're ready to sunset and expire. Yes. So with that said, it means that the government estimates that over the next 5 years, we will have 26,000 new units built over the next 5 years, which is roughly a 2% bump over the baseline housing supply projections.
So housing is going higher.
Yeah, we're going to build more homes, 2% more, which is a far cry from the ambitious housing plan that voters were promised. The pledges of doubling home construction over the next decade really doesn't look like it's going to happen. And the PBO, which is the Parliamentary Budget Office, they still say that there is no detailed plan showing that will happen.
Thus the decline in spending.
Right. Well, because of the current programs that we have that are ready to sunset and expire. So with those programs expiring and dropping from 9 billion, where we're at 9.8 billion, to where we're at right now, dropping to 4.3 as it's supposed to be in 2028, 29, that reduces the amount of housing that would be built without that 7.3 billion that's been put aside for the build new homes. Right? So that means that we're only going to roughly have about a 2% increase in housing built. And so I really wanted to outline maybe why this has happened, because I wanted us to all consider who's leading this housing promise. And it is our good friend that we talked about before, Gregor Robertson. Right? So I just wanted to reflect, because as mayor of Vancouver from 2008 to 2018, coincidentally, actually, when I moved here in 2007, Robertson made headlines by making promises, most notably to end street homelessness by 2015. Yet by the time he left office, official homeless counts in Vancouver had climbed from about 1,576 in 2008 to 2,181 in 2018. More people were without stable housing than when he began. And during his tenure, the city launched policies such as the Vancouver Affordable Housing Agency, which is where the Build Homes program that the federal government put in place, that is actually what it's mapped off of. Right? What's that, Geoff? Sorry?
It's mapped off of a success story.
Right. So we'll get into that. So when he launched policies such as the VAHA, the Vancouver Affordable Housing Agency, and incentive programs for rentals like STIR, which was the short-term incentives for rentals, and Rental 100 to spur rental housing development. So in total, many critics say that the output never matched the scale of crisis. Home prices in Vancouver soared. The benchmark for a single semi-detached home rose from roughly 827,000 at the beginning of his term to over 2.3 million by 2018. So in other words, under Robertson's watch, unaffordability got worse for many. Less homes, of course, got built in Vancouver, even though the programs sounded good on paper. So what I wanted to circle back to was just to say, if his mayoral record teaches us anything, it's that good intentions and bold announcements don't guarantee real results. The housing crisis doesn't respond to slogans. It needs clear plans, sustained funding, and execution that matches the promises. And given that history, the modest projections for Build Canada homes and the projected drop in overall housing spending make me question whether this will meaningfully improve affordability for everyday Canadians. And Geoff, that is what I wanted to get your thoughts on.
It's a lot to unpack there.
Yeah.
Well, I guess my first thoughts is that it's built on a model that hasn't proven to work, right?
Right.
But looks good on paper. So that's my immediate response.
That's what I wanted to bring to light.
Yeah. And then my other part of that is that, are we having a slowdown in spending or house development because we have so much inventory that's on the market? Now, I say that in Ontario, Vancouver, some will say Montreal, but is that also a reason why there's been a cutback in that spending? Because again, we are in a correction or a real estate correction, and does that have any impact on what's being done? So those are my two immediate thoughts.
So my comment to what you just said there is it could, but then it still doesn't make any sense for affordability, right? Because what Robertson has always said, and we've talked about how it doesn't really make sense. He says he wants to improve affordability, bring the cost of properties down, without hurting the current values of homes.
Yeah.
Right. And I've always said, how does that even work? Right. That's talking out of two sides of your mouth. And the only way that you can foreseeably make that work, right, is by creating new categories and making those categories cheaper, which would then dilute the actual current number, right? So if you've got let's just say we've got townhomes, apartment condos, and single detached, right? So if you take that number and let's say that number is 1 million, but then you create, right, high rise, modular, and something else, and make that number 500,000, right? Well, now you've diluted the number to $750,000, and you can now say, right, we've got affordable housing because our average home price is $750,000.
Yeah.
That's just a shell game, right? So if we're not putting the spending into creating, right, new categories, then you're not actually changing the value of homes, and now you're going against what you said of making properties affordable.
Well, I just listened to Benjamin Tao over the last week, and what he has said is that, look, and let's talk the condo market, right?
Yeah.
He says, look, there is so much supply that's out there. We are going to continue to see a correction for the next 2 years.
Yeah.
And until that, and then his insight was, and then coming into year 3, when now all that supply is slowly gone, that's when we're going to start to see a correction in the condo market and the prices coming back to where they need to be. Now, in saying that too, a lot of development that's happening, now isn't going into that resale kind of development anymore. It's going more into rental projects, right? Rental development.
Right.
And, again, to your point is if you're cutting back housing, as far as the building of housing by 56%, it kind of ties into what he is saying because there is not going to be a continued abundance of inventory to what we already have. In fact, it's going to basically slow down the inventory. It's the as far as development goes, the resale or pre-sale is actually now going to turn into more of a rental project versus
Yeah.
a pre-sale project, which is actually one of the very first times that shift has happened in a very, very long time. And again, like, how are you going to have affordable housing? Like right now, I think we have affordable housing. There's a consensus that housing is going to continue to drop 5 to 10%, depending on who you talk to, depending on who you ask. And even if you take a look on when development or when properties, I was talking to a developer friend of mine, he has a one bedroom or he had a one bedroom condo that was selling for $523,000 3 years ago.
Yeah.
That same condo is now selling today, 3 years later, for 423,000. And basically he feels it's going to drop another 5 to 10%. So, that correction as far as affordability is happening. We are in it. Some will say we are almost over the hump of it,
Yeah.
and or not over the hump, but we're slowly coming to the top of it, with the understanding that, hey, yes, prices, and we'll talk condos, are going to continue to come down. By how much? Let's see what that crystal ball has to offer. But again, as supply diminishes, you know, prices are going to correct themselves, which they always, always do at some period of time.
Well,
Right.
100%, because one of the things that we used to hear consistently, and I'll get more into it once we get into the insights with Allister segment, because I'm going to do a market review because the numbers came out for last month. But one of the things that consistently drove our prices in the past was we had limited inventory,
Yeah.
right? And now we've just been saddled with more inventory than we've seen for the past 10 years.
Yeah.
Right?
Yeah.
So that's to your point. Once that inventory goes away, we'll be back into that limited inventory, and pricing, of course, increases yet once again.
Yeah.
But we still will not have touched affordability, right? Because if we're complaining, and I agree, I think I have we have kind of the number that we've reached back to in terms of what our pricing set at. If we're considering that pricing right now is unaffordable, how are we going to say that pricing is going to be more affordable in 2 years?
Yeah.
It
Well,
won't be.
again, based on the conversation Benjamin Tell is having, is he feels that, again, we are at the low point of interest rates. We may see 10 to 15 basis point drop, either way, but from his insight, and again, he's got more of a thumb on the pulse, like he's dealing with the finance minister. He's having those conversations, and he feels that our rates are where they're going to be. In fact, they might drop a little bit, they might increase a little bit, but it's not going to be a huge substantial difference. And his forecast come 2027, this is where we're going to start to see rates rise again. So again, when you take a look at housing, where we're at now in a corrected market, we take a look at rates, which are, again, I've always said, is that we're in the second lowest rate environment that the country has seen since, outside of COVID. Now is a time to buy, or I'm going to say within the next 1 to 24 months is going to be the time to buy. Because again, based on this conversation with Benjamin Tao, he does feel that rates are going to rise by 2027. He feels that within the next 3 years, we're going to see a increase in pricing on condos. And keep in mind too that a lot of the things that are going on isn't happening countrywide either. It's happening in Ontario, it's
Yeah.
happening in Vancouver. Some will say that it's happening in Montreal. That's maybe a little bigger of an argument as far as what that is, but it's really happening here in Vancouver and Ontario, right?
Yeah.
as far as the pricing conversation that we're going.
Right.
So, affordable housing, when is it going to happen? I think the time is now.
Yeah, and I agree. And that's one thing I always want people to remember is that Canada will always have an easier time, like Canada as a whole will always have an easier time saying it has an affordable housing because of the other provinces like Manitoba, Saskatchewan, right? Newfoundland, Nova Scotia, where where pricing is vastly lower than it is here. And they will just continually say that places like British Columbia and Ontario, and to your point, right, Alberta or Quebec are outliers, right? They're outliers, and they just face their own unique challenges,
Hmm.
right? And so that's where, again, to your point, we in these provinces, if we're British Columbia, Ontario, right, we have to be smarter in our decisions. So when we see rates coming down as low as they have, when we see that prices are lower than we've seen in years, right? When we've seen that happen, that should be our cue that things are affordable and to take action if we can,
Yeah.
right? As opposed to, again, as we always say, trying to time a market. Because the more you try to time a market, the more you're going to lose, right? The more you're going to mistime the market and then all of a sudden be paying more than what you assumed. And you're going to say, I should have bought last year.
Yeah. We are right now, I feel that we are in a fearful market.
Yes,
But one of my favorite sayings is from Warren Buffett: be greedy when people are fearful, and be fearful when people are greedy.
that's exactly it.
So again, riding off of that, people are fearful. This is the time that people should basically be taking advantage of that fear and capitalizing on it. Because again, this thing will turn. Nobody has that exact crystal ball outside of history. And when you take a look at history, regardless of the Great Depression, regardless of war, regardless of 2008, everything comes back out of the storm, right? It's just a matter of when and in many cases, how, right? But that how always figures itself out some way, somehow down the road.
Absolutely. Absolutely. Awesome, man. Well, that actually is a good transition into my insights for the week because what I wanted to deliver is the market update for the Fraser Valley. I don't have Vancouver's numbers just yet, but to just in terms, and it's been the same. It's been really the same story all year long. The Vancouver board has really matched the Fraser Valley board in terms of listings and the pace of sales and stuff like that. So let's get into the Fraser Valley market update for November 25. And really, guys, it's as we settle into late fall, the market it's still showing its usual seasonal slowdown, right? So it's winter time, which is always the slow period of real estate just on a traditional basis. But so after a little bit of momentum in the fall, we saw a relatively active September. October was a little bit slow. Sales dipped in November, coming in at 943 homes sold, which was down 16% from October and 17% below last November.
Wow.
Yeah. So even with more homes on the market and slightly lower prices, of course, buyers are moving carefully. No new listings slowed to 2,210, which was 26% down from last month.
As far as listings go.
And as far as new listings go, yeah, 2,210 down, 26% down from October. But as I was saying earlier, inventory still remains high at 9,201 active listings, which is well above the 10-year average. So again, for buyers, as Geoff and I have been pointing out, right, this means more choice and more room to negotiate. And right now, of course, the thing that's pervasive is affordability, and tighter economic conditions are continuing, to influence decisions. But composite prices, and this is where I wanted to get into pricing, composite prices are closer to early 2023 levels. So this is where I was saying, right? This is when we're talking about, right, is it the right time to buy? Are things affordable? Well, we have now dropped back to pricing that was early 2023, right? So these are the levels that should be helping all of our buyers kind of trigger that this is the time for them to get into the active market, if they can. So, of course, the Fraser Valley is firmly a buyer's market with sales to active listings at 10%. So basically, 1 out of 10 properties are selling, people. Right? Again, that's and homes are taking a bit longer to sell. Right now, single family homes are at 52 days on market. Townhomes are at 37 days in market, and condos are sitting at 41 days on market. 41 days. Yeah. And in terms of pricing, single family homes in the Fraser Valley are now at an average of 1.4 million, which is down 0.6% from last month and down 5.4% below last year.
In an already declining market.
In an already declining market. Townhomes are 779,000, which is down 0.8% month over month and down 6.8% year over year. And as we were talking about condos are now, the average condo is now 497,000, which is down 1% from October and 6.9% below last year. So those are the real estate stats for the Fraser Valley for November 2025. And like I said, I'll try to have Vancouver's for next week, but the story will be much the same, just at higher price points, because it's the Lower Mainland.
So what I'm hearing is sales are down.
As they've been.
Sales are down even over the last year.
Yeah.
People are not putting their housing on the market as they once were. I think that's what you said, because that's down a 26% or 26%. Okay.
Yeah.
Yet there's still a whack load of inventory out there.
Yeah, we still got more than the 10-year average. Yes. Yeah. And prices continue to drop month by month and year to year, year over year. And this is where it goes back to saying we are now back at 2023 pricing.
Yeah. Goes to my example where this 1-bedroom condo was going for 523,000. Today that 1-bedroom condo is going for 423,000.
Right.
You're already getting $100,000 discount year over year over year. And again, based on this developer, and which is in line to, the number is it's going to drop another 5 to 10%, right? So I guess this guy's a little bit smarter than he thinks he is.
A little bit, right?
He pretty much nailed it.
Yeah, and that's the thing. Again, to all the buyers out there, this is, you guys have been pleading and pleading and yelling, screaming for the ability to negotiate. This is your time. Like, in all honesty, this has been the time that every buyer has been asking for, right? The ability to negotiate on a property, as opposed to consistently getting into multiple offer situations or having to pay what list price is and all that sort of stuff, right? This is the time, right, that you've been asking for. And for sellers out there, this is a plea from all of us to please be realistic. If you want to be able to sell, again, we're in a buyer's market of 10% sales to active listing ratio, sales to active ratio. So that's what I said. 1 out of every 10 homes is selling. So if you want it to be yours, You have to be priced accurately and you have to show to sell. So you no longer are we in a period of time where you can just throw your home on the market, ask for whatever you want, let it be in whatever condition that you want it to be, and say, well, people are just going to buy it or I'll price it for that condition. That's not the way it looks anymore. When people are looking at your home to buy, they're putting equal value in your pricing and what your property looks like. So if you figure, well, I'm just gonna I didn't put anything in, I haven't renovated or painted or done anything for the past 30 years, and I'll put it up for this and I'll just say, well, it's priced for that. That doesn't guarantee that you're gonna have a sale. Because again, buyers out there right now, because there's so much inventory, right? They're picky, right? They want the most value that they can get for their dollar because they feel like they've earned the right to do so now.
Mm-hmm. Yeah.
Right. And so that's just a caution for everybody out there, right? Buyers, this is your time to shine. Sellers, this is your time that you got to work. The roles have been reversed. The roles have been reversed. And the smart people right now, and I shouldn't say smart, I don't want to say that, people that aren't taking advantage of this aren't intelligent, but the smart people are taking advantage of this time right now, right? So that they're not looking back, in 1 to 2 years saying, I should have bought last year. There's so many people that are still sitting there saying, I should have bought before COVID. That's the craziest thing that I'll still hear right now is I should have bought before COVID. Well, COVID's long gone. And this is your chance to buy now and you're still sitting on the sidelines.
Yeah, I should have invested in gold 5 years ago.
Right, exactly, right? I should have bought Apple stock when it first came out. Like everybody's got that story, but
yeah. The old famous saying in hindsight is 2020.
Exactly. Well, that's the insights, Geoff. What do you got for us today?
Well, I wanted to share a story and really kind of share a story with you, with our listeners about blended families and the trouble that this particular blended family was having getting financing. One of the few people that are buying your home, possibly, right?
Good for him.
And wanting to buy a home, but
Right.
running into speed bumps. And I wanted to share the story. I wanted to share the outcome because I think it's really, really relevant to a lot of people that listen to our podcast. Now, the reality of it is blended families are just that. You're coming into a second relationship. You're bringing your kids from your first marriage into it, and this is happening more and more and more. Again, we take a look at our divorce statistics. I think it's either 6 or 7 out of 10 people are getting divorced. The highest divorce rates are usually within years 5 to 7 of your marriage, and then from 22 to 25 years in the marriage. And what happens is that if you are going if you are divorced, the reality of it is you're going to get into another relationship, marriage at some point. And when you're combining your families together, in this particular case, the mom had 2 children from her previous marriage. The father had shared custody from his previous marriage, so this is now a blended family of 5. They were going in and wanting to buy, and they were going to their bank. They themselves were going to their bank, and they were saying, "Hey, we want to buy a place. This is what this place is for," and their bank said no. Then they went to another bank. That bank said no. Then they went to another bank, and that bank said no. And then they finally came to us, and we were, again, we do these discovery calls and we're asking the questions. And, on the surface, it looks pretty messy, right? Like on the surface, you have a mother that because of her first divorce, her credit wasn't where it needed to be. There was arrears in there. There was collections in there. There was missed payments. And really why that was just because she was going through a life event. And that was the reason why. It wasn't it was a little bit of the inability to pay, but they were going through a life event, or she was going through a life event where all the financial onus came onto her and she just couldn't manage, right? So that was a speed bump number one. The other speed bump was the dad, or the gentleman. Again, he shared custody. He obviously has a support payment for that, for his child, and he was obligated, let's say, to pay $500 a month, as per his divorce agreement. But again, there are good dads out there that go through a divorce and say, you know what, we're going to, here's $600, here's $700, here's $800, and paying above what he's obligated to pay based on the separation agreement. So the bank takes a look at 3 months of bank statements, takes a look at what this gentleman's being paid out, and based on the bank statements, as far as what the support payments are looking like, is you're not debt servicing. You know, you can't debt service based on the support payment. And then the third thing is that he's in construction, and I'm not going to say he's a seasonal worker, but there's times throughout the year where you can and where you can't work, right? And because he was in construction, there was what we would call fluctuating income. So when you would take a look at his pay stub, you could see that that year-to-date income wasn't where it needed to be to get the financing that they were looking for. So, through all of this, not with their bank, but also with another bank and a bank thereafter. And we've talked about this before. You just don't debt service for what you want to do, right? And remember, folks, the debt servicing is the money that you're bringing in to the money that's going out. Depending on your credit score, it has to be within 42 to 44% of your income, to simplify it. So these folks, this family, wasn't debt servicing. So again, looking at these and recognizing what the speed bumps were going to be, we basically took this to lenders, and explained the situation. And the situation with credit was like, look, here's a life event. This is what happened. If you take a look on after the life event corrected itself, and you take a look at the history of the lady's credit, there is no issue with the credit. Yes, there was high utilization. What was that from? Because of the divorce. Yes, there was missed payments. What was that from? It was because of the divorce. This thing went into arrears because of the divorce, and it was a shared, debt that he wasn't going to pay, she wasn't going to pay, therefore it went into arrears. So if you put a good explanation behind it before being asked, was basically step number one. Speed bump number two was when you took a look at this gentleman's bank statements, the support payments that were going out, they were higher than what he was obligated to pay. But again, as a good father, maybe even in some people's case where they have a support payment, as a good woman or a mother, they give above and beyond because they're able to do so throughout the year or throughout these months. And when you take a look at it, he was obligated to pay, let's say $500. He wasn't obligated to pay $8, but then the debt servicing should be going based on the obligation, not based on what he's been paying in the last 3 months. So it's based on what's outlined within that separation agreement and what he's legally contracted to do as a support payment. And the third speed bump was the income. So again, yes, he's a construction worker. There is times where his income fluctuates. And because of that, you should be using a 2-year average. For whatever reason, the 2-year average wasn't factored in. Once we took a look at it, we factored in the 2-year average. We supported the document with what's legally obligated on the support payment. We put explanation behind why the credit was where it needed to be. And then all of a sudden, Allister, guess what's happened?
They got approved.
That no turned into a yes. And this is where I go, folks, is that when you are getting your financing done, please don't go on your own to your bank and basically see how they can help you. Number one, it's going to take 3 to 4 weeks before they even get back to you. Number two, by the time they get back to you, might not be an answer that you want to hear because you have a unique, file. And I jokingly say to people, is like, look, if you got a good job, you got great credit, and you got a down payment. Alistair, how old is your youngest kid?
Well, 13.
Your 13-year-old kid can do that mortgage. It really is that easy. But again,
She is smart.
but again, if your 13-year-old kid doesn't understand fluctuating income, if someone doesn't understand the reason why credit is blemished, if they don't understand when taking a look at a bank statement as far as what's contractually obligated to versus what's being paid, they are not, or she is not, or whomever is not going to get that financing done because they are not asking the right questions. So again, folks, if you are in a unique situation, that could be credit challenged, that could be income challenged, that could be business for self and what you're reporting for income. These are those unique kind of situations where you need somebody that knows what they're doing. Because, like I said, if you have great income, you got great credit, and you have a down payment, Alistair's 13-year-old kid can do that for you. In fact, if you have a child that's probably in grade 3, probably can do that mortgage for you. But if you have any uniqueness to your situation, this is where you need a strong person, a strong lending partner that's going to get you to where you need to be. And if it's going to be a no, then you know it's not going to be a yes somewhere else. And we see this all the time. So again, I just felt it was important because quite honestly, we are looking at files like this more so because it is harder to get financing. Lenders are becoming a lot more adverse to risk, so they are putting everything under the microscope.
Yeah.
And if you don't have explanation or if you don't have the experience to fight for a file that makes sense, you are going to get declined for financing. That's my mic drop.
That's no, that's awesome. And so like I'm glad you brought that up because the CEO actually of our board, his name's Baldev, his name's Baldev Guild. He had mentioned that one of the reasons that he feels that the market is a little bit slower is because lenders are tightening, right? And there's a lot of scrutiny in terms of giving people mortgages and all that sort of good stuff, and their lenders are tightening their belt. And it made me think again back to when you told me this story earlier, right? Just how important it is, like we say, to have an advocate for you on your power team, to make sure that the people on your power team are an advocate for you and can tell people your story,
Yeah.
right? It's again not to knock banks. This is not a comment to knock banks, but you've always said, right? A bank would rather things just be easy, right? Just kind of be cookie cutter. Oh, let me look at the screen. Okay, you fit that bucket, on you go. Perfect, right? And as soon as you sort of start slipping outside of that bucket, start slipping outside of the walls there, right? And it becomes a little bit more difficult. The easier answer is no. It's just the easier answer, right? So again, that's why, Geoff and I continue to just say it. Like, we want it to be us, of course, right? But if you are working with somebody, make sure they're your advocate.
Yeah.
Make sure they can speak your story.
And this is not a slag just on banks. This is just a scenario.
Sure.
Brokers can just be as bad, right?
Mhm.
I always say to people, there's 18,000 mortgage brokers you can choose from. but 16,000 of them are not very good. There's 25,000 realtors in the greater Vancouver area, but
Betcha.
22,000 of them aren't very good.
Yeah.
Right? So this is not a slag on the banks. This is just a slag on brokers. This is a slag on bankers that basically cannot look past the narrow lenses that they have.
Yeah.
Right. And like you said, Allister, be an advocate for the file, especially if it works.
Yeah. Yeah. That's exactly it. Yeah. And to Jeff's point too, with like Jeff was saying, is, there's a lot of realtors out there that, if you're not just an easy, I'm going to buy this in this location and sell my home, right? They don't want to deal with you because it starts becoming difficult. Again, right? Every person's situation is unique. We're all snowflakes, right? Every person's situation needs to have things tailored for them, and the people working their power team, again, just they need to have advocates that understand their needs and basically march their needs and profess their needs until the job gets done. But that's awesome, Jeff.
Yeah.
Amazing.
All right, my man. Let's
wrap her up,
sign
man.
it off.
Let's wrap her up. That was a good pod today. Well, everybody, again, thank you all for taking the time to listen to us today. We hope, as always, that this information has been valuable to you guys, because as we've said and continue to say this entire year, we have doubled down on making sure we get you the most valuable content. We're coming up to December 31st, so Jeff and I are going to have to figure out a way for next year to triple it for you. But we hope we've been doing our job for you this year. Again, we hope you all have a great weekend. If you guys have Christmas parties and all those sort of gatherings going on, be safe out there, right? Enjoy yourselves, but most importantly, be safe. Enjoy your family, enjoy your friends, enjoy your co-workers. And with that being said, continue to love, like us, share us, tell everybody you know about us, start yelling about us during the Christmas parties and all that sort of stuff, saying you listen to this great podcast. But most importantly, stay empowered, stay informed, and Jeff,
stay tuned.
That's right, baby. Stay tuned. Peace out.